Why is TLT falling back as the dollar is losing ground? Yet 2023 will reveal the truth of quantitative tightening. And there will be tears. My 2023 prediction: I predict that the Fed will continue to escalate their campaign of incompetence. They went too far on QE and causing the highest inflation in 40 years. They will do it again with QT and causing the most depressed deflation. There will be blood on the street, and Wall Street will continue to escalate their campaign of fraud until it all explodes with extreme devastation. Bullish pundits who assert that us skeptics have been wrong this whole time will be viewed as accomplices to their fraud. In the short term, what are we seeing the smart money is positioning? Is the dumb money doing the opposite? For those that don't know, Santa Claus rally theoretically happens right after Christmas into the first 2 days of January. So we haven't even really seen what they call the Santa Claus rally yet. What if Santa Claus doesn't even come to town? What could that tell us about January and the rest of 2023? We do have a bearish engulfing candle in place, waiting for the close for the year. That could really decide the fate of 2023. Stay tuned for that. Why is TLT falling back? At the same time, the dollar is losing ground. I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here. And you know what to do, and push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you are a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing, author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get into the bookstore. You want it to be real. You want it to be true. You need to be my client, don't you? When Jeffrey Gundlach speaks, financial markets around the globe listen carefully. The founder and CEO of Double Line, a Los Angeles-based investment boutique mainly specializing in bonds, ranks among America's highest profile investors. On Wall Street, he is known for speaking his mind. According to his view, one of the biggest risks right now is that the Federal Reserve is doing considerable damage to the economy with its aggressive rate hikes. The next shock is that we're having to put in a big overreaction to the inflation problem, which we created from our initial reaction of excess stimulus. Mr. Gundlach says, my guess is that we will end up creating momentum that's more deflationary than a lot of people believe is even possible. The Federal Reserve is very keen on preserving what is left of its credibility and reputation because they have not been able to execute on their interest rate plans for many years. Every time they try to tighten monetary policy, it doesn't take long for the economy to get weak, and they get embarrassed. In the past, the Fed was able to pivot like it did at the end of 2018, when it completely reversed its course in just 6 weeks because the stock market collapsed. It was able to do that because the inflation rate was still below 2%. So it didn't seem to have much of a near-term consequence. This time, the Fed has said forcefully and repeatedly that they are going to bring inflation down. Therefore, they are not in a position to do a quick pivot. Basically, the idea is that they are going to hike interest rates more, hold it for a bit, and then they are going to drop them back down. To me, that is a strange thing to predict, because why bother with anything then? If you're taking rates up and then back down, why bother taking them up? Why not just do nothing? It's like a 6-foot tall man who's in shape and weighs 105 pounds saying, I'm going to put on 100 pounds this holiday season, and then I'll take it off with a crash diet by Easter. What's the point of that? That's not healthy. It's very bad. What they're implying here is that the inflation rate goes down from 9% to 2%. Which is the Fed's goal within a year or by the end of next year. But if this would be really possible, if the inflation rate were to fall so quickly and so sharply, why do you think it would stop at 2%? Why wouldn't you think it goes negative? Why wouldn't you think so much momentum towards a slowing economy might overshoot on the deflation side? Due to the lockdown, we did this huge amount of radical economic policy. The idea was that it was going to be free money and free growth with no bad consequences. But of course, we've had bad consequences. Now people are thinking we can just do this reactionary shock to the economy by taking the federal funds rate up to 4.5%. But if that's enough to weaken the economy to take 7 percentage points off the inflation rate, why wouldn't it be 15 percentage points? That's 9 minus 15 equals -6. -6%. So maybe we are going to get a delayed reaction. That's deflationary. Just like we had a delayed reaction that was highly inflationary. These shock and awe tactics work with a delay, and if you overdo them, you end up getting tremendous incremental volatility. We've had so much economic volatility in the past 2.5 years compared with the preceding decade where the economy grew more or less steadily at 2% and the inflation rate never truly budged. Then we introduced all these extraordinary policies that work with a lag. We just keep doing them until they kick in after the lag, and by then we've greatly overdone it. I think that's the message of the bond market. Why else would we have interest rates so far below the inflation rate? And 91% inverted yield curve. On top of this highly volatile situation, we have a Fed that is expected to do $1 trillion of quantitative tightening over the next 12 months. This will add to economic weakness. The consumer is very weak, as you can see with some of the upper middle class oriented retail chains like Nordstrom. Nordstrom stock lost 25% just last month. All these things that are aspirational purchases rather than necessities have fallen off the cliffs because people have to spend too much money on gasoline and food. In contrast, low-end retailers like Walmart had an explosion in new customers. Many of them used to shop at Whole Foods. Now they shop at Walmart because the food is also reporting a significant shift in their consumers paying with credit cards, not debit cards. In other words, shoppers are borrowing money to buy food. The weak links investors should pay close attention to. I see Credit Suisse is backing away from trying to be a Wall Street and United States titan. Their stock just seems to never go up. In the American economy, the weak links are producers and retailers of discretionary goods because the people don't have the money to buy them. We're in an economy that doesn't have the liquidity. There is no more funding for questionable ventures, for non-profitable businesses. In the short term, we see dumb money are buying recently into the market while the smart money is selling into any small rally that comes in their way. After Christmas, if the Santa Claus rally doesn't show before the new year, and if we actually heading down south, it will be a very bad sign for January and the rest of 2023 in the stock market, because we are currently having a bearish engulfing candle signal on S&P 500 for the year of 2022. There are only 5 of this signal since 1889. Average downside was 30 to 50% down after signal triggered. If we are going down before the new year comes, there will be blood on the street in 2023. So why was both dollar and treasury bonds sold off recently? A surprise move by the Bank of Japan recently triggered a rise in bond yields and strengthened a move lower in the US dollar. The Bank of Japan unexpectedly lifted its ceiling on a 10-year government bonds from 0.25% to 0.50%. The BOJ lifted the ceiling to stop an unwelcome slide in the yen. In response, bond yields also jumped in the US. For the first time in a decade, all major central banks are tightening, with Japan still doing the least. And don't expect the new cap to hold either. Dollar milkshake will be sucked out. Japan is the 3rd largest in the world by nominal GDP, and the 4th largest by purchasing power parity. It is the world's 2nd largest developed economy. To simplify, Japanese have huge incentive to bring capital back to Japan, sucking capital away from the world, namely from the USA. This could be another reason why 2023 will be red. This is my client Teddy Eazzy's book, Wicked Pussy Perfume. It is an erotic novel, such an awesome book. Order your copy for the new year. And my client Lee Vinson's book, The 3 Most Important Influencers You Need to Meet. And my very first book, Treasures Within Our Heart. All great books. You are such a good boy for watching my video right till the end. Bye.